Welcome, let's get started. When stepping into the world of investing, one of the first and most important decisions you'll face is choosing between individual stocks and exchange-traded funds, commonly known as ETFs. Both options offer unique advantages and challenges, and the choice you make can significantly influence your investment journey. Let's break down the differences, explore the pros and cons, and help you determine which approach might be smarter for beginners. Imagine you're just starting out. The allure of picking stocks, choosing companies you believe in or hope will skyrocket in value is undeniable. There's something exciting about owning a slice of Apple, Tesla, or your favorite up-and-coming tech startup. You can research companies, read their financial statements, follow their news, and make decisions based on your convictions. But with this excitement comes risk, and for beginners, that risk can be daunting. Investing in individual stocks means putting your money into a single company. If it performs well, you reap the rewards. But if it falters, your investment can take a hit. Stock prices can be volatile, influenced by factors ranging from company earnings to global events, or even a single tweet from a CEO. On the other hand, ETFs offer a different approach. An ETF is a basket of stocks or other assets designed to track an index or a specific sector. For example, instead of buying shares of one company, you could buy an ETF that tracks the S&P 500, giving you exposure to 500 of the largest companies in the United States. With one purchase, you diversify your investment across hundreds of businesses. This diversification is a key advantage for beginners. By spreading your money across many companies, you reduce the impact of any single stock's poor performance. If one company struggles, the losses are offset by others that are thriving. This can create a smoother ride and help new investors avoid the emotional roller coaster that often comes with individual stocks. Let's delve deeper into the advantages ETFs bring to the table. First, they're cost-effective. Many ETFs charge very low fees, especially those that track major indexes. These costs, called expense ratios, are typically a fraction of a percent annually. Compare this to mutual funds, which might charge higher fees for active management, and you'll see why ETFs are popular among cost-conscious investors. Second, ETFs are easy to buy and sell. They trade on stock exchanges just like individual stocks, meaning you can purchase them through any brokerage account, often with no commission fees. You can buy as little as a single share, making them accessible even if you're starting with a modest amount of money. Third, they're transparent. Most ETFs disclose their holdings daily, so you know exactly what you own. Whether you're investing in a broad market ETF or one focused on a specific sector like technology or healthcare, you can see the list of companies included and understand where your money is going. But ETFs aren't without their drawbacks. While diversification reduces risk, it also means you might not enjoy the dramatic gains that can come from picking a winning stock. If Apple has an incredible year and you own the S&P 500 ETF, you'll benefit, but only a little, because Apple is just one of hundreds of companies in the fund. For some investors, this can feel like missing out. Additionally, some ETFs are more complicated than they appear. While broad market ETFs are simple and straightforward, there are others that track niche sectors, use leverage, or invest in exotic assets. For beginners, these specialized ETFs can be confusing and risky. It's important to stick with funds that are easy to understand and have a long track record. Now, let's turn back to stocks. The biggest advantage of investing in individual companies is the potential for high returns. If you pick the next Amazon or Tesla early, your investment can multiply in value. There's also the satisfaction of doing your research, making informed decisions, and seeing your efforts pay off. However, this approach requires time, knowledge, and discipline. Successful stock picking means analyzing financial reports, understanding market trends, and keeping up with news that could affect your investments. Emotional reactions, like panic selling during a downturn or chasing after hot stocks, can lead to costly mistakes. For beginners, this learning curve can be steep and sometimes overwhelming. There's also the risk of lack of diversification. If you put all your money into one or a few stocks and they perform poorly, your portfolio could suffer significant losses. That's why experienced investors often recommend holding at least 10 to 15 different stocks spread across various industries. But building such a portfolio takes time, effort, and often more money than a beginner might have. So, which is smarter for beginners? The answer depends on your goals, interests, and risk tolerance. If you're looking for a simple, low-cost, and relatively low-risk way to start investing, ETFs are an excellent choice. You can gain exposure to thousands of companies with a single purchase, minimize your fees, and avoid the pitfalls of trying to time the market or pick individual winners. For most beginners, starting with a broad market ETF, like one that tracks the S&P 500 or a total stock market index, is a smart way to lay the foundation for long-term growth. If you're interested in learning more, have time to research, and are willing to accept the risks, you might consider adding individual stocks to your portfolio. Some investors like to start with a core holding in ETFs and then use a small portion of their money to buy stocks they believe in. This way, you get the best of both worlds: diversified stability and the excitement of stock picking. No matter which path you choose, remember that investing is a journey, not a sprint. The most important thing is to start early, invest consistently, and keep learning. Over time, the power of compounding will work in your favor, and your financial future will grow brighter. In summary, for most beginners, ETFs offer a smarter, safer, and more accessible way to get started in the stock market. They provide instant diversification, low fees, and simplicity. As you gain experience and confidence, you can explore individual stocks and refine your strategy. The key is to start now, stay curious, and let your investments work for you. Whether you choose ETFs, stocks, or a combination of both, your journey into investing begins with a single step. So take it today and watch your financial knowledge and wealth grow. Thanks for watching. Be sure to like, comment, and subscribe for more.